Real gross domestic product, or real GDP, is a measure of U.S. economic activity adjusted for inflation. Early estimates show the economy grew at an annual rate of 2.4% from the prior period. The third reading for the first quarter, based on more complete data, was released in June with a rate of 2%, resulting in a 90 basis point increase from the second reading of 1.1%. The Atlanta Fed's GDP Now, a running estimate of real GDP growth, projected a Q3 rate of 5.9% as of August 25th, following the release of housing starts and new residential sales data from the Census Bureau. This slide shows the job openings in blue and the unemployment rate in red. The unemployment rate for July is 3.5% and has been relatively unchanged since July of last year, when the prior record low of the same rate was reached. Following the peak non-farm job openings reading of 12 million in March of last year, there has been a 20% decline to the current number of 9.6 million job openings. It is important to note, however, that this is still significantly higher than the pre-pandemic average of 7 million openings. This slide shows us the labor force participation rate. It's an important factor in the unemployment rate calculation and has steadily increased after reaching a low of 60.1% in 2020. It now remains above prior cycle lows with a rate of 62.6% for July. Finally, this slide provides the three main measures of inflation. The downward trend overall is a welcome sight if you're seeking a pause in Fed rate hikes. The aquamarine line, or CPI, is currently at 3.3%. PCE, the Fed's favorite inflation measure, is the red line and currently has a rate of 3%. Then we have PPI at 0.8%. That measures the prices paid by companies for the goods they need to provide their products to consumers.
One of the key indicators that we watch is the federal funds target rate. This rate will drive short-term borrowing as well as prime. The Fed paused their rate hikes in June, but followed that up with a 25 basis point increase in July. There are 3 meetings left this year: September, November, and December. There's a tool that we watch on the CME website that indicates what the market thinks they will do. Currently, they're expecting them to pause again in September. If you look at the current rate hike cycle, they have increased the rate by 525 basis points in just 496 days, which is the top chart. The bottom chart shows the previous rate hike cycle from 2015 to 2018. This one took 1,099 days to increase the rate by just 275 basis points. This is quite a difference, and the economy is feeling that difference. The dot plot that was released from the March meeting indicated that most of the FOMC members expected the rate to end 2023 at 5% to 5.25%. The most recent one in June now indicates that they are expecting to end the year slightly higher at 5.5% to 5.75%. Remember that this is a point-in-time indication of what the FOMC members expect for the rate in the future. There has been a lot of talk about liquidity for banks. This list shows 20 large banks and their deposit growth year over year as well as quarter over quarter. Most of these banks have seen a decrease in their deposits from June of 2022. Most of this outflow occurred after the collapse of Silicon Valley Bank and Signature Bank in mid-March. Some customers moved their funds out of the banking industry. The good news is that most have seen their deposits grow from the end of Q1 to the end of Q2 in 2023. This means that customers are feeling better about the banking industry or finding ways to insure their funds. Stearns Bank does partner with the IntraFi network to help get our customers increased insurance on their deposits. If you have questions, please feel free to reach out.
Now, one of the associations that we monitor reported that 21% of business owners borrowed or tried to borrow money in the last 3 months, and that was pretty stable month over month. And of those businesses, they report their financing needs included operating or inventory expense, replacement of capital assets or to make repairs to expand their business, and to refinance or pay down debt. And loan types did include term loans with the most popular term requests of 3 to 5 years and lines of credit. Now, this would indicate that there's plenty of businesses who still seek financing, and there are a variety of industries to pursue. This slide summarizes the percent of monthly commercial account originations by the age of the business. And what we're seeing is that there's an increased volume of businesses with less than 2 years who are requesting credit, but there's also a healthy volume of businesses that have been in business for 3+ years who are seeking credit. Now, other metrics to be aware of are delinquencies and bankruptcies for commercial. Now, both of those are showing an uptick at this time, and so those are metrics that will continue to be monitored. And it'll be important for credit managers and accounts receivable managers to continue to look at borrowers and determine where does it make sense to help them with a payment deferral, and where does it make sense to hold their feet to the fire and require that they stay with their payment terms. And there is an increase in bankruptcies right now with some businesses in some sectors, and so those will be metrics that we'll continue to monitor. Now, turning to consumer debt trends, mortgage and non-mortgage debt overall has declined slightly recently. However, revolving has reached its highest level since 2010 at nearly $1 trillion. Credit limits are at an all-time high for revolving, and utilization is increasing, indicating consumers are turning to revolving lines to supplement cash flow. So it'll be important to monitor delinquencies going forward to ensure that consumers are able to service that debt.